This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers from PWL Capital.
Welcome to episode 289, and this week, Ben, we have a fantastic episode where we invited, and we're super grateful to welcome three experts to give a counter argument to an episode of the Dave Ramsey Show that was aired on November 2nd, which really took a run at the 4% rule, safe withdrawal rate. So we thought, well, let's get the three gentlemen who wrote an article as a counter argument to that opinion, and they all agreed to join us. So joining us today will be Michael Finke, Wade Pfau, and Dave Blanchett. Dave's been on the show twice. Wade's been with us once, and this is the first-time visit for Michael. So with that, Ben, before we do a bit of their bios, why don't you set up the episode that happened on the Dave Ramsey Show?
Well, yeah. So, I made a video responding to this too. I think a lot of people made content. You'll hear these guys explain why. It was just a great opportunity to educate people on why Dave was wrong, because he was so wrong about so many different things. He basically just said that retirees could safely withdraw 8% from their portfolio each year on the assumption that you're going to earn 12% per year, which is incorrect for a whole bunch of reasons that you'll hear these guys talk about in a minute. And then there's going to be 4% inflation. So you're going to earn 12%, you're going to lose 4% to inflation, which leaves 8% that you can safely spend. Now that's ridiculous for a whole bunch of reasons. I won't explain why right now, because you're going to hear the best people in the world, quite literally, to give the explanation in a minute.
Yes.
Yeah. So that was a big problem. But then the other thing was, he was very vitriolic and very pointed toward people who do financial planning research. So you'll hear these three guys. The goobers, yeah, the super nerds, whatever you want to call them. Lots of mean stuff. But you'll hear how thoughtful these guys are in a minute. I don't know how many published papers they have between the three of them, but it's got to be in the hundreds. Like, each one of them has published a huge number of papers on retirement income planning. They've done a ton of co-authored papers as well. I think they must all be buddies. But so that was it. So Dave came across as so abrasive on this topic that he was clearly so wrong about that it made a lot of people want to respond. And these guys wrote an article for Think Advisor where they said super nerds unite against Dave Ramsey's 8% safe withdrawal rate guidance. And they basically went through all of the reasons why this doesn't make sense. And it was a funny scenario overall, because Dave was so Dave's words were his word choice was comically aggressive. So anyway, you and I talked about it. It's like, should we invite these guys on, because we know David and Wade, and so you reached out and they were willing to come on, which is awesome. But this is like the brain trust of retirement income planning globally. Like, it doesn't get better than these guys.
So let me give a brief bio of each of them, because their backgrounds are incredible. So Dave Blanchett's managing director and head of retirement research for PGIM DC Solutions. He's the adjunct professor of wealth management at the American College of Financial Services. All three of our guests are research fellows for the Alliance for Lifetime Income. And Dave's also the co-host of Wealth Managed podcast with our other guest, Michael Finke. Michael's is a first-time guest on the podcast. He's professor of wealth management for the American College of Financial Services and their Frank M. Engel Distinguished Chair in Economic Security. And Wade Pfau, second-time guest. He's the co-creator of the Retirement Income Style Awareness Tool and the director of retirement research at McLean Asset Management, professor of practice at the American College of Financial Services, and also co-hosts a podcast called Retire with Style with co-host Alex Murgoya.
Yep. It's a good introduction.
Three great communicators, three great guys, and this is one fantastic conversation about a topic. I just love this topic.
Yeah,
I love the nuance about the value of having variable spending rates in retirement. It's so fascinating, the impact it can have. And we asked him that question. How big an impact? I mean, you'll be blown away by how important it is to understand this.
But it's also such a complex topic because you could spend a career going down that variable spending pathway and how to optimize it and how people should be doing it and all that kind of stuff. But as you hear Wade talk about, that's not the best way to do this mathematically, and more subjectively, it's not the best way to do it for most people based on their research. They find that 2/3 of people prefer somewhat of a safety first approach, with the alternative being variable spending from a portfolio of risky assets. I do want to mention at the top here, just in case people miss it at the very end, Wade has a tool to help people assess their retirement income style. It's the RISA tool. And he is giving us a URL that we'll post in the show notes where people can access the RISA profiler and figure out what their retirement income style is, which is pretty cool.
Love it. Okay, Ben, with that, let's go to our conversation with three experts, David Blanchett, Michael Finke, and Wade Pfau. David Blanchett, Michael Finke, and Wade Pfau, welcome to the Rational Minder podcast.
Thank you.
Great to be here.
It's great to have you guys. I know, David, you've been on twice. Wade, you've been on once. And Michael, it's great to have you on.
It's good to be here.
Okay, let's kick it off with a very technical question. Do any of you guys actually live in your mother's basement?
So I don't, but I used to live with my grandmom, if that's close enough. I lived with her for about a year, not my mom's basement. So.
Yeah, and where I'm at in Texas, we don't even have basements. But
that's
my
right.
mother
Yeah,
does
I'm in
have
Texas too. The basements don't even exist here.
I never realized there were houses without basements.
That's like the perfect response, Wade. It's too funny.
And what's your favorite type of calculator, each of you?
Oh, I use Excel. I'm an Excel guy, a huge Excel junkie. So, I mean, it used to be like the TABA 2+ back in the day, but I've evolved into just a full Excel junkie.
Well, yeah, for me back in high school, it was all about those graphing calculators that you could convert into game playing machines and all kinds of things. I thought it was the TI-85. I think that was the popular one back in the day.
Wow.
Don't
Michael?
you miss the 12C though? Don't you have a certain amount of reverence for the 12C? I mean, it just is like this. It's so 80s. It's like 80s finance person. It's this brick. It's backwards. All the logic of it doesn't make any sense. Like only a few people really understand how to use it. It's indestructible. I mean, the 12C, there's nothing better.
I remember that reverse logic. That was something.
It was, yeah.
Okay, so let's kick it off a little more serious note. Why did you guys decide to respond to Dave Ramsey's claim that 8% is a safe retirement spending rate?
Well, that's not a new claim from him, and I think we probably have all responded to it before. We've really had the foundation at this point to know for at least 30 years that that's not really a statement that makes any sense. So I suppose it was just a matter of he's calling out all the researchers out there who are saying that you have to look at more conservative numbers and 8% should be fine. I think it's something that needs to be responded to because he does have so many listeners.
I think you meant goobers, not researchers, Wade, just for the record.
That's right.
I think for me, what got me was his aggressive negativity. And it sounded like, I forget the gentleman's name that's actually done research on his website talking about 4 or 5%. Them just
they said George, I think. George.
Yeah, just going on, George. How wrong it was. That was and I think his daughter was about to correct him, but didn't. And so I think there's chances in there where he just kept saying things that were so wrong that it was like a new level. To Wade's point, he's been saying this for a decade, but that was kind of next level hate on good advice.
He was really aggressive against you guys as a group, not you specifically, but researchers in this space as a group.
And I think that one of the great opportunities is when someone says something like this that is so over the top wrong that it's a great opportunity to then go back to why it's wrong and to be able to remind people that there is such a thing as a sequence of returns, that you don't get 12% return per year on stocks, and that has some implications on what happens to your portfolio. If you get some bad years, and you don't adjust your spending, then you're spending a lot of money, but your portfolio is smaller. Even if you get a higher return, it's not going to bail you out. All of these concepts, I think we all know them intuitively, and a lot of advisors have heard stuff like sequence of return risk, but they don't really know how to visualize it in a very simple way. And so I thought, well, this is an opportunity to just explain some of these fundamental concepts that most of us who do retirement income research, we talk about them all the time, but we don't really explain the basics. And because he was so wrong, it was just such a wonderful opportunity to explain the basics of retirement income planning.
Can we keep going in that direction? What specifically does Dave Ramsey get wrong about retirement math to justify the 8% spending claim?
What does he get right? I mean, you can ask that question two ways. I'll let Wade and Michael take it from here.
Well, yeah, I mean, he's just doing a really basic calculation. He's saying the stock market historically averages 12%, which the first issue there is that's in a single year. But if you look at growth over time, it's going to be less than that. But even saying the market grows 12%, he's assuming you get 12% every year. And so you just build a simple spreadsheet. And the idea is, he says, you take out 8%, there's 4% to account for the inflation. Every year, your portfolio is going to grow 12%. You're taking out like an 8% real amount from that, and you just continue to increase your spending for inflation throughout retirement. And you, in that regard, you never even dip into your principal because there's no volatility. Every year, your market portfolio grows 12%, and you consistently spend and enjoy and never face any sort of issues or risks or anything else in your retirement plan. That's the calculation he's doing in his mind, and just what's wrong about it is just the reality that markets are volatile. People do have to pay investment fees. Market volatility reduces the growth rate of assets compared to just a simple calculation of what's the average historical return. So you can't really spend as much, and it assumes people are holding 100% stocks throughout retirement, which is not going to be a common occurrence as well. So that's the basic idea of what he gets wrong.
Now, this is such a great opportunity to talk about the way that economists think about taking investment risk, because to an economist, risk means dispersion. You know, there's a range of potential outcomes. You could get unlucky, you could get lucky. You have to live with the consequences of getting either unlucky or lucky. And he's just assuming that there is no risk. And there would be no reward for investing in stocks if there was no risk. But because there's risk, there is an expected reward, not necessarily a guaranteed reward, but we expect that on average, you're going to get a higher return. But part of that bargain is that you have to accept a wider range of outcomes. And if it just so happens that you get bad, unlucky outcomes at the beginning of retirement, that screws everything up with the math.
So we know that he likes American funds, some of which have done very well for a long time. Would an 8% withdrawal rate work for investors who happen to have owned those, ex post successful funds?
So, I mean, it would have some of the time, right? I mean, I think Wade, I've looked at this for over a decade. I mean, like, some investors get really lucky. I mean, if you retire, the markets go up 10, 20% a year, like you're in great shape. The problem is it doesn't always do that. And so, like, the short answer is sure, it's worked some of the time. It's not going to work all the time. And while American funds, those funds have done pretty well, like things, and Wade did this over a decade ago, things look very different if you use other countries' historical return. So sure, sometimes it's worked, but I think an expectation that is an incredibly unrealistic withdrawal from a portfolio.
Another aspect too is when you look at the historical data, like if you look starting in 1982, markets did very well. And so an 8% withdrawal rate would have worked fine for a retiree in 1982. But if you look at what it took to get to 1982, they struggled with market returns, a very high inflation, volatile, low returning type environment throughout the 70s and the early 80s there. So they wouldn't have had as much wealth. And so even though they do get to enjoy, in the case of 1982, maybe even close to a 10% withdrawal rate, it's not that they have such a dramatically better retirement than anyone else when you consider the lower starting base. And yeah, sometimes the 8% spending rate will work. It's just not going to be a common occurrence. And it's going to have a high likelihood of depleting the portfolio if you really insist on spending that amount every year.
There's this kind of annoying tendency to look backward and try to project something unusual happening in the future or an added amount of safety if you just would have followed this strategy. So in retirement income planning, I've seen some articles where people say, well, if you just would have been more value stock heavy, or if you just would have, taken advantage of some of these factors that historically had outperformed, you could have withdrawn more money from your portfolio. Well, all you have to do is look backwards and figure out what did better. So, for example, if there was a family of funds that outperformed historically, you can say, well, if you just invested in those smart things, those good funds, then you could have withdrawn more. And of course, if back when a lot of this research was really popular, you had moved into small cap value and thought that that would have been the key to allowing you to spend more every year more safely, and then you went through a period like the last 5 years, I mean, you would have just gotten slapped by the higher performance of growth it's essentially, if you're just looking in the rear view mirror, then you can always come up with a rationale for how people could have spent more money. But oftentimes that rationale doesn't really play out in the future. So you can't really count on magic fairy dust to save you or to give you some amazing ability to be able to spend more than you otherwise could in an efficient market.
Can you guys talk about how important sequence of return risk is to how investors fund their retirement consumption?
Sure. It's kind of one of the key ingredients of what makes retirement different from pre-retirement. When you think about wealth management or wealth accumulation, you as a saver can benefit from a market downturn, because if you're saving, you get to buy more shares and a better overall position. It reverses in retirement when you're taking distributions. If there's a market downturn and you're having to sell shares to fund expenses, you're having to sell more shares to meet a particular spending need. Those shares are gone, and then even if the overall market recovers, your portfolio doesn't get to enjoy the full recovery. So the market returns in the early retirement years have a really disproportionate impact. And what it does is it amplifies investment volatility, because take where the 4% rule idea comes from. It was based on you could hold a 50-50 portfolio of stocks and bonds starting in the US data, starting in 1966 through 1995. The average return over that 30-year period wasn't all that terrible, but it was the sequence of returns. You had high inflation and downturns in the financial markets in the late 1960s, and then the big downturn in 73 and 74. I already mentioned 1982, that the best case scenario in history begins halfway through the worst case scenario in history. You could have used almost a 10% withdrawal rate starting in 1982. That's halfway through the 1966 hypothetical retirement. But by that point, it was too late for that 1966 retiree. They were on the trajectory to the worst case scenario.
Wow.
Because they're spending from their portfolio. And so they don't get to enjoy the market recovery that happens after 1982. That their portfolio is already on track it's headed towards zero, and worst case in history begins, the best case in history begins halfway through the worst case in history. That's really sequence of returns risk in a nutshell.
Yeah, I mean, I think sequence of return risk makes retirement kind of very unfair, where you could have the same exact geometric return over the 30-year time horizon, but be able to spend 2 or 3 times more. And so, for better or for worse, we all only have one retirement path. You can run a 1,000 Monte Carlo, 100,000, how many ever number you want to choose, but everyone's path is different. And the returns you experience when you first retire kind of radically affect that outcome. So as you move through your retirement, you move towards the certainty of an outcome. But, if you're lucky enough to retire when the market goes up, you're probably going to be in great shape. A lot of folks aren't that lucky. And I think that's where this idea that you should be invested 100% in equities when you retire, it's just a really bad idea. I think there's very few people that would suggest retirees should be invested all in stocks, given how much risk that places on that particular path for that retiree.
Do you think there's a point where people are going to have too much in bonds and that becomes actually risky for a retiree?
Yeah, with bonds, you have to take a look at the yield curve and see, well, how much can I support? I could build a bond ladder and not have to worry about the short term, the volatility if I hold these bonds to maturity. you can calculate exactly how much you're able to spend. And as soon as you try to spend more than that, bonds are going to ensure failure. And so the trade-off becomes, do I want to invest in stocks with the hope of growth to spend at a higher level than bonds can support? But certainly, yeah, in the historical data, the 4% rule in Bill Bengen's initial article, he said, always hold at least 50% stocks. Later, when you break it down a little more, you could go as low as 35% stocks. But below that, the 4% rule plummets. You much lower withdrawal rate as you get to lower and lower stock allocations. And even in the international data, I did a study about sustainable spending with 20 different countries, financial market data back to 1900. In 18 of the 20 countries, the best case scenario, like the safe max, the highest spending rate you could have done in the worst case scenario, occurred with at least 50% stocks in 18 of the 20 countries. It was only Sweden and Switzerland where a lower stock allocation would have worked better than a higher stock allocation. So yes, you can definitely go too low with bonds if you want to spend more than bonds can support.
I'm going to get a little geeky here because that's what we do, and say that the answer to that question depends a lot on the bonus that investors are getting for taking investment risk. And that bonus that investors are getting for taking investment risk, it's not guaranteed. And it seems to be higher and lower in different eras. For example, if stocks are priced at a level that suggests less growth in the future, then the trade-off of a higher bond allocation is going to be less significant. And it seems like a good indicator is how much are people paying for a dollar of average profit that the company made over the last 10 years, or in the S&P 500, how much are people paying for a dollar of profit? That's actually very predictive of the performance that you're going to get in the future from stocks. And stocks are expensive right now. So stocks are more than twice as expensive per dollar of historical profit as they have been historically in the United States. So you wouldn't expect that stocks are necessarily going to provide that same benefit over bonds that they have in the United States. It's just, it's almost impossible for them to do what they've done historically when they're priced as they are today for today's retirees. That's going to influence the trade-offs of having a higher bond allocation in a marketplace like the one that exists right now, where bond yields are relatively high and stocks are pretty expensive. It's very possible that in the future, safe withdrawal rates are going to be pretty similar between a higher stock allocation and a lower stock allocation. I know, David, would you agree with that? You've also done a lot of research in this area.
I think it's very time dependent, right? I think that, right now you've got real yields on tips at 2%. They were negative, 3 years ago. So I think that this idea, there is this kind of time dependence. I think that, the future returns on the stock market is a lot more uncertain. I think there's going to be winners and losers. I think that the role that bonds could play in a portfolio, it really does vary over time. I think that right now you can make a much better case for them than you could maybe 2 or 3 years ago. But look at what happened in 2020. Everything was down over 10%. So I think it requires this kind of constant evaluation. But I do believe that for most retirees, it's important to be somewhere in the middle, right? You shouldn't be all in fixed income. You shouldn't be all in equities. I don't know, what the band is for that sweet spot, but there really are, I think, risks on both ends of that spectrum.
Can you guys talk about how the risk of being in stocks changes at longer investment horizons versus shorter ones?
I would love to. I'm actually doing so we did a paper on this about a decade ago. I think it was actually part of my PhD dissertation. Michael, is that correct? And I think that there's this kind of assumption that exists that returns are independent over time, right? That returns follow a random walk. And the thing is that hasn't been the case. A lot of advisors talk about time diversification. The risk of every asset out there increases over longer investment time horizons. Risk does not go down, risk goes up. But the risk goes up at different rates. And what we've seen historically across multiple countries is that the risk of equities changes at a different rate than the risk of fixed income. And that equities can become increasingly attractive especially for investors who are concerned about inflation, the longer you hold them, right? Nominal bonds aren't necessarily a great longer-term inflation hedge. Some of the structural drivers of equity returns really are kind of a good way or decent way to hedge long-term inflation. So I think the key is to look at the data historically. Returns don't evolve non-randomly, and that there has been a pronounced benefit across most countries over most time periods. Where if you're gonna be a longer-term investor, it does benefit you to be a bit more aggressive.
There's another little subtle detail with retirement income and long-term horizons that usually with a longer time horizon, it points to a higher stock allocation, even in retirement, even though there's sequence of returns risk. But what happens is the longer the time horizon, you have to look at a lower withdrawal rate to be sustainable over the longer time horizon. And as you lower the withdrawal rate to help the money to last for longer, that reduces the sequence of returns risk. And so that makes it easier for a higher stock allocation to weather any storms and support that longer time horizon. But it's because the withdrawal rate is lower that it's really behind the scenes what's driving that sort of outcome as well.
Oh man, that's interesting. So a longer time horizon requires a lower safe withdrawal rate, which allows for a higher equity allocation.
Right. Exactly.
That's very cool. What about, can you guys talk about how, so we can say stocks maybe get a little bit less risky at longer horizons. What about subjective risk tolerance? How does subjective risk tolerance change with fluctuations in the market?
Well, Michael, I mean, everyone's rational, right? People don't vary their expectations over time, right?
Yeah, there is this, what I like to call the inverse law of demand rule with stocks. And that is that as prices go up, people want more. And as prices go down, people want less. And in fact, that's what shows up when you look at consumer risk tolerance surveys. We've looked at it from investors that work with a financial advisor. We've looked at participants in retirement plans, and we see the same thing, which is that when the market has gone down and stocks are cheaper, people are more risk averse. And when the market has gone up and stocks are more expensive, people are more risk tolerant. They want to take more investment risk. That actually leads to consistent underperformance. There have been mutual fund studies that find that the average investor loses about 1.4% per year, compared to someone that just doesn't make any changes at all in response to changes in the market. And the biggest mistake is to sell stocks after they've fallen in value. That's where people lose the most money. Now, consequently, we also spend a lot of time doing research on investor behavior in retirement plans. And what we see is that target date fund investors, who tend to be the least financially sophisticated investors, they lower income, less education, they actually outperform everybody else because they're not doing anything. So in some cases, being blissfully ignorant is actually in your best interest as an individual investor because you're not tempted to make these changes that result in lower performance over time.
Love it.
I think a really important point about this notion of time varying risk aversion is who exhibits it the most. I think that if I were to ask you, like, hey, who do you think is out there, actively trading when the markets go wrong, you would say, oh, it's probably younger people because they haven't done this before. Like they haven't been through ups and downs. That is unequivocally false, right? Our research shows that it's older investors, participants, etc., that exhibit this effect. And we don't know why, but if I had to guess, what is it that drives this variation in risk tolerance and trading activity? It's like the salience of retirement. I mean, I think retirement's like a mirage when you're 35 years old. It's gonna happen at some point in the future, no big deal. But I think as individuals kind of move to the retirement, they're increasingly kind of concerned about, oh my God, if my portfolio goes down by 20%, I can no longer go on vacation. So I've got to sell to kind of lock this in. And so I think that's a really important point about this. So people like Dave Ramsey say, hey, stocks go up more than bonds, you should be heavily invested. He's somehow assuming that investors that have all this wealth will stay invested. I just question that assumption a lot for older individuals, for those who are retired and don't want to go back to work. So I think that this idea that people can stay in for the long term, it doesn't jive with reality, especially among retirees, older investors that don't want to go back and work and are more kind of, subject to market downturns.
So David, do you think it's the percentage on that amount or is it the dollar value? Like a bigger portfolio, 20% is a much bigger absolute number. Is that what's really driving it, do you think?
So, Michael, I mean, we looked at this. I just think it's just age. I don't know that I think it's just the implications on lifestyle, because the problem with the balance is $500,000 could mean a lot more to me than your $5 million balance based upon our lifestyle, our lifestyles, our goals, our preferences, our guaranteed lifetime income amounts, all these different things.
Right.
And I think, I mean, again, totally could be wrong. I think what happens with this age factor is it just becomes very real. Like, people who are 25 don't spend a lot of time thinking about how much they're going to have when they retire. What are the implications of a drop? But anyone that's a few years away, they're like checking their, like my in-laws are like every day they're checking their balance. And one day they called me up, there's like a dividend imposed on it, like call Fidelity, so like they're actively concerned. They're like hyper focused. And that hyper focus, I think, actually hurts them versus, as Michael said, folks that buy target date funds that aren't as sophisticated because they just don't worry about it.
So you're saying older investors, just by age, that's the variable we're looking at, their subjective risk tolerance becomes more sensitive to market fluctuations. Is that the idea?
And the more equities they have, the more sensitive they become. And that's really the big risk of encouraging older investors to take excessive investment risk, is that they may not capture the benefit from taking all that risk. So in other words, they may get all the volatility and none of that bonus that you expect to get above bond returns for accepting investment risk, because the more risk you take, the more sensitive you tend to get.
And this counters a little bit. There was a whole line of research maybe 10 or 15 years ago that talked about the portfolio size effect, which was saying that like target date funds got it all wrong. They had higher stock allocations when you were younger and didn't really save much yet. So there was really nothing at stake. If the market doubled, you maybe gain a couple $1,000s because you haven't saved much. But then by the time you get to your target date, that's where you have 30 years worth of savings. A given market upturn or downturn can have a much bigger impact. But that argument was, this is your only opportunity to actually benefit from market growth. And so you should have the higher stock allocation near retirement. And that's more quantitatively trying to look at what might work best. But you do got to consider the real world implications of people's comfort and ability to stay the course, not panic, and whether that market volatility and as the research that Michael and David have done notes, that does become harder to do with age.
Okay, so you guys are like the perfect people to ask this question to. There's a paper going around right now, you may have seen it, that shows in a sort of quasi-empirical setting using bootstrap sampling of a big historical data set, that being 100% in equities with a big chunk of international equities, so big domestic international split 50-50, dominates any other asset allocation. Target date, any of the age, stocks minus age type things, anything that has bonds in it basically gets dominated by this all stock portfolio. What do you guys think about that?
Well, I've seen the paper, I have the data, but I'm not a robot and people aren't robots, right? That's I mean, that's just not realistic, right? Like, no person that works with real humans would suggest that. I mean, it's also, I know the paper you're talking about, and Michael and I have been doing research on investors for longer time horizons. I just don't believe it. I think that we don't know what's going to happen over longer time horizons. I like the fact that they took like 10 years of bootstrap data because they capture the time diversification effects over. So it's a better way to think about it versus pure IID returns, but it's not clear how much all that's going to persist in the future, right? We don't know what's going to happen. There are these growing dependencies across global economies historically. So I fundamentally I would never recommend that for a retiree investor.
I want to talk about this because I think it's a good way to revisit investment theory again, which is something that I love. First of all, a 100% equity portfolio is never going to be the Sharpe ratio maximizing portfolio. In other words, the amount of extra return you're getting for a given level of risk is never going to be maximized by a 100% equity portfolio. Even using the historical data, which probably overestimate the amount of equity returns that we're going to be able to get in the future. And the right way to do it is to select the Sharpe ratio maximizing portfolio. And if we want to take a little bit of extra risk, then we can maybe leverage it. But if you incorporate these leverage constraints, then you can say, well, maybe 100% equities is the right approach. There's a lot of reasons why equities historically might have outperformed. If we think about how difficult it was for people to invest in equities, the transaction costs. I mean, you had to trade. It would cost you $70 to make a trade back in the early 1970s. You could not put together a well-diversified portfolio at a low cost. You had very high capital gains tax rates in the United States. It was just far more difficult to even capture the equity risk premium historically. And it's one of the reasons why you would have expected it to be higher to induce investors to buy stock in the first place. Today, we've gone from like 1 out of every 7 people owning stock to 1 out of every 2. People do it automatically in their retirement savings account. And the question becomes like, how much of a reward do you really need to give people today to get them to invest in stock as opposed to investing in bonds? That's going to determine then whether or not going forward, that allocation of 100% equities is the right strategy. Because if that equity risk premium is really only, say, 200 or 300 basis points, then there's going to be a lot more risk, a lot more variation in future lifestyle outcomes than has existed historically. So, and essentially, it all is based on this premise that there is a stock premium puzzle. So an equity premium puzzle, which has existed historically, there's just no way to justify it in any sort of rational model. And if that's going to persist in the future, then something that has no basis in efficient markets has to continue in the future. And I'm just not willing to place my bets on that. Like a lot of economists, I just don't think that you can get something for nothing. And essentially what they're saying is you can get an equity risk premium with very minimal downside historically.
Any thoughts,
Fascinating
Wade?
answer.
I saw the abstract of that paper, and I feel like these kinds of papers come out every few years. I haven't read this particular one to know if it's got some secret sauce that did something different, but either I remember a few years ago, it was you should actually leverage your portfolio and be 200 or 300% stocks, or every couple of years someone writes in the New York Times how retirees should be 100% stocks because of the risk premium. And yeah, if you assume a high enough risk premium, you can get to 100% stocks, giving you the highest safe withdrawal rate. In that international study that I did with the 20 different countries, I think there were 5 countries that the worst case scenario was the best with 100% stocks. It's can people actually pull that off and feel comfortable with that? Or is it, as Michael's alluding to as well, can you really rely on that sort of risk premium environment as a surety for the future? Yeah, I just don't really tend to. I agree that the pure quantitative research usually does point to higher stock allocations. I don't know about 100% stocks. I'd have to see exactly what they were assuming. But in practical terms, it doesn't get you very far to just tell retirees they should be 100% stocks, because mathematically it will support the highest withdrawal rates.
Yeah, I mean, to be like, an important nuance here, right, is if you assume returns are independent, it doesn't usually work 100%. But when you incorporate the zero dependence over time, and like in the piece that you're referring to, that's where you tend to see this benefit. And I think others have very different perspectives on how that will persist in the future. And I think it will. I think there are some important kind of diversifying effects of equities versus bonds over longer time horizons. But even like the remote suggestion that 100 people should be 100% equities just doesn't pass even like the most basic sniff test, in my opinion.
That was good. Good comments all around.
So what do you guys think about Dave Ramsey's suggestion that the 4% rule is just too depressing?
I actually agree. I think that a lot of the assumptions that we use in our models are overly conservative. I think that success rates are not a great way to quantify outcomes. They ignore the fact that the portfolio is only a marginal part of someone's total assets. If you think about what Dave Ramsey is talking about, it's actually more of an endowment approach versus an initial withdrawal increased by inflation. So I think that 5% is a more realistic starting place than say 4% for most Americans. When you capture the total economic balance sheet, way we quantify outcome, the way we make changes over time. I'm even okay with 6% for a lot of people. That's not out of bounds. I think that 8% though is just a step too far. So I agree that I think a lot of the key assumptions in the 4% rule are way too conservative. But again, it depends upon your situation, your preferences, all that.
Yeah, the 4% rule was just a set of simplified assumptions to point out sequence of returns risk exists. I never really thought about it as being depressing. I guess anytime you have to tighten your belt or pay down debt or anything of that nature, that can be a little bit depressing. And yeah, I agree with David too, that one of the primary assumptions of the 4% rule that you always increase your spending for inflation every year. If you can relax that assumption and build in some dynamism, that helps manage sequence risk. And so that can allow for higher initial spending rates. And so you can, and there's other, well, David's retirement spending smile, the idea that people don't really need their spending to grow with inflation.
Right.
You can definitely get yourself set at a higher sustainable spending rate than 4%. But I think it's still just a reasonable baseline. You need some set of assumptions so you can make comparisons about what's somewhat realistic versus not at all realistic. And in that regard, I think it plays its role. It's just, it was never meant to be an actual retirement strategy. It's more a research simplification. And sometimes people take it too far. And then I even see sometimes people say, well, no one ever, all these advisors think the 4% rule is what you're supposed to use. That I've found this secret trick that no, you use a variable spending strategy. No, yeah, we all understand that. It's just a research simplification, a starting point. Maybe depressing, but I never had really thought about it that way.
Michael?
Yeah, let's talk about some of the issues with the 4% rule. So the 4% rule assumes that you're going to spend the exact same amount of money adjusted for inflation every single year, no matter what happens in the market. And of course, any human being, if they got a bad sequence of returns, if they saw their money that's starting to dwindle a little bit, they're going to cut back on spending. That's just what we do. And in fact, most of us have space in a retirement budget to cut back a little bit. And that gives us the ability to start at a higher level and then adjust based on how well our investments are doing. But it also highlights one of the major inefficiencies of the 4% rule. And that is that there is a huge amount of unintended bequests for people who didn't adjust upward. What does that mean? So if you get lucky and you started out with $1 million, all of a sudden the market does well, you're at age 75, 80, you've got $2 million. Am I going to continue to spend the exact same amount of money when I know that if I would have just simply retired today and someone was using the 4% rule, they would have increased my spending up to a higher amount? So we have to give people the ability to spend more if that's their goal from that money. And that's why I think you have to be very clear about what your legacy goal is and what your income goal is. And once you do that, then you have to give people, first of all, the flexibility to decrease their spending if the markets don't do well, but also the ability to, I think it's something that we just don't talk enough about. And that is that it is, in some ways, a fiduciary violation not to encourage your client to spend more if that's the goal of that money. So if you set the money aside, the market does well, they've got plenty, they're going to be just fine. You need to give them the license to be able to spend the money that they've saved so that, because oftentimes with an advisor, they have an incentive not to, basically to scare you so that you don't spend that money. But a lot of people could live better if they were going on more cruises or if they were even giving gifts, to relatives. They could live better instead of simply dying with more money that really represents just a lot of joy that was unspent.
Yep.
Okay, so you guys all talked about various types of dynamic spending or variable spending. David, you mentioned potentially even a 6% initial withdrawal rate if you're willing to take some variability. Can you talk about some of the alternative approaches to spending from portfolio of risky assets? So the 4% rule is constant inflation-adjusted withdrawals. What else could people be doing?
Lots of ways to do it, right? I think that it's just a question. I mean, you can rerun a financial plan. There's modified RMDs, there's guardrails, there's lots. I mean, like, I don't know that there's one way that's better. I think that you could run analysis and based upon your assumptions and everything else. And, I mean, like one thing that I fully acknowledge is that there's a mass amount of estimation error in any kind of financial plan, right? We don't know where someone's going to be next year, the following 5 years, the following 10 years. But I think what's important is that, if you run a financial plan and you use static assumptions, you're not replicating what they're going to do in real life. And so I don't get kind of too caught up on like how someone should do it. I just think it's increasingly important that as we're doing these plans for people, like using financial planning software, we somehow capture this, because the retirement isn't static, it's dynamic. And why this all matters is just that what happens is this frees up money you could have spent earlier in retirement. When you acknowledge the capacity to make these changes, I think it would make people more comfortable going on those vacations and doing more when they're younger.
Yeah, and in terms of, like David said, probably the most realistic kind of approach is people they spend what they need to spend or what they want to spend. And maybe if ideally they're going to do a periodic check-in, see if what they're spending is sustainable. And if it's not, if maybe that's realized as if the probability of success in the financial plan starts to dip too low, maybe they'll make some cuts at that point. Now, when it comes to doing research about variable spending strategies, you can't test that sort of ad hoc approach. So then there are kind of clearly delineated variable spending strategies to look at. I've looked at a number of those, and just two of the ones that I have a somewhat more favorable look upon is Bill Bengen developed one of them. He called it the floor and ceiling rule. It's just you use a fixed percentage of what's left. Rather, the 4% rule is really about the first year of retirement. You spend 4% of the balance, and then you increase that amount for inflation every year. A fixed percentage rule is you spend a fixed percentage of what's left every year. And so your spending is going to fluctuate, but then you have a dollar floor and a dollar ceiling that will adjust for inflation, and you don't let the spending go outside of those bounds. So that's a way to build in some variability that can allow for a higher initial withdrawal rate, that then ultimately the floor with that strategy may not be all that much less than you get with the constant inflation adjusted spending of a 4% rule style rule. The other one I like too, and it's more for discretionary expenses, if you have a floor of income already, is some sort of modified RMD rule. And that's in the US required. Well, it's basically an actuarial rule. As you age, your time horizon gets shorter, so you can spend an increasing percentage of what's left in the portfolio. And then because your portfolio is fluctuating in value, it will lead to variable spending, but it's a way to spend down the assets more efficiently, and you can use that money for discretionary types goals, or maybe even as a part of the legacy, but rather than waiting to the end of retirement, a way to share that while you're still alive and can see the benefit of those gifts and so forth.
In general, how much do you think a dynamic spending strategy can improve that initial withdrawal rate? Like, do you have any rough sense of, you met someone, what you'd say, how much improvement it could be?
25% or more, I would say. I mean, again, I think what's really important is
Wow.
thinking about the role of dynamic withdrawals. There's kind of really, at a minimum, two important toggles that exist. One is how much guaranteed income does someone have, right?
Yep.
So earlier I'd said like 6% makes sense. Well, like if you have like, you're getting like $100,000 a year from Social Security, whatever it is, and your 401k is $100,000. They got 6%. Like, who cares? Like, I mean, that's like $6,000. You get $100,000 from Social Security. You're gonna be fine, right? But if for some reason you have no guaranteed income, and your entire portfolio is going to fund your retirement, well, that changes things, right? And there's this question, well, like how flexible are you? Like, do you have all of your essential expenditures covered from existing guaranteed income? You can go crazy. If you don't have any of it covered, it's gonna really kind of reduce your ability to kind of make a change. So I think that, but if you use better, more realistic models, at least what I've found is that, like, that's why I say 5% is like the new 4%, because I think incorporating just dynamic rules moves you from 4 to 5. If you overlay how retirees don't increase their funding in retirement or spending by inflation, it can go to 6%. So I think at a minimum it's 20-25%, but it can be a lot more than that using kind of other more realistic assumptions.
It's a lot.
So if you increase that initial withdrawal rate at the beginning of retirement, I think it's also important to remember that it's going to affect the average slope of your lifestyle over time. So if you start out with a higher income goal and then you adjust from that higher income goal, the median is going to have a lower slope than if you started out at, say, 4%. you're going to be able at the median to generate a higher slope over time. But a lot of this has to do with how do you want to live? And I think my perspective, I want to be able to spend more money when I'm physically and cognitively able to actually enjoy it. I mean, if you think about the average retirement period for, say, a healthy 65-year-old woman, she gets 25 years on average. She may get more, she may get less. But on average, if you think about it as like 2 rows of 10 dots and 1 row of 5 dots, she has a certain amount of savings and she's got to fill each one of those dots with her savings. And how do you do it in a way that's going to make you the happiest? I'm going to maybe put more of my chips on some of those early years. And that is one of the reasons why I might want a higher initial withdrawal rate. But I have to recognize that I'm depleting my portfolio faster if I get unlucky. That's going to lead to some worst case scenarios where I might have to cut back significantly later on.
And also recognizing too, being related to that idea of front loading your spending. For a lot of people, their spending doesn't keep up with inflation, other than possibly uncertain health expenses. David has the retirement spending smile concept, and looking at what he created with data, I tested, well, how much could your initial withdrawal rate change if you simply applied the spending smile, which is your spending doesn't keep up with inflation, it dips. In the scenario I looked at, David, it was about a 26% real drop by age, whatever, mid 80s somewhere, and then starts creeping up due to late in life healthcare expenses. But applying that pattern compared to inflation adjusted spending, you could increase the initial distribution rate by 17%. And that was still without any sort of variability based on market conditions. It was simply the variability in spending of a fixed pattern that you incorporated. So if you then added on a variable spending strategy on top of that as well, yeah, you could easily get to a much higher number. But yeah, you don't necessarily, it's already a fairly conservative assumption to assume when you're 95 years old, you want to spend the same inflation adjusted amount as you did when you were 65 years old.
Yep.
Okay. So we talked about how much of a potential boost you can get in the first year withdrawal. How much variability kind of year to year do people have to deal with if they're implementing this kind of strategy?
So I think like there's the modeling assumption, then there's like real life, right? So like what you'll find if you model these, we're gonna use the fun fancy word stochastically, like there can be lots of variability in these over time. Right. I think that's just to provide directional context of where you could be heading. I think that, like, yeah, the model, like endowments, like do 20 quarter averages. And so I think that you can imply smoothing effects on spending evolution. It just depends on what you're willing to do. Right. I think that like one thing I just always get back to is just all the things that life throws at you. You cannot capture in a financial plan. So I think that it's our job to do a good job and to kind of try to reflect how things evolve on average. But I think that we've got to be realistic and say, hey, like over the next 30 years, no one knows what's going to happen. So let's keep it reasonable, but not worry too much about kind of all these nuanced details about, like one thing I say is like, why are returns the only random variable in our projections, right? You could have life expectancy. I think that retirement age should be a random variable because most people retire early and that can devastate a financial plan. So, I mean, I get why, like, I think one random variable hurts most people's minds. If you had like 3 or 4, it would they would just lose it and people's heads would start exploding. But like there's a lot more that can happen in life than just a bad market that would kind of devastate your retirement plan.
And also the variability in spending would be less than the variability in the portfolio distribution, because when you look at the overall spending, you probably have Social Security or other types of pension income that are not fluctuating with the market. So to the extent that covers a portion of spending, it reduces the variability of overall spending. And then with taxes, if you're having to cut your spending, that may also be partly offset by lower taxes as well. And so on an after-tax basis, you will see fluctuations in spending, but it may not be as dramatic as what we were talking about with like what could potentially be the drop in the portfolio distribution.
Michael, you have something?
I'll just mention quickly that the more rigid your withdrawal strategy, the higher likelihood that you're going to run out. So, a guardrail strategy which says that you can only adjust down a certain percentage, that's going to result in, for the very unlucky retirees, a certain percent are actually going to run out because they can't adjust enough. They should have adjusted downward more. So anytime you adjust the adjustments, you add, because you're never going to run out of money if you have a high enough adjustment. Then essentially, you can every year adjust your expected longevity and whatever the value of your portfolio is. As you become more rigid, as you limit the amount of adjustment, that exposes you to that risk of potential failure over time. So really what you're doing is you're widening the range of potential lifestyle outcomes by allowing a higher adjustment every year, but you're also protecting yourself against the possibility of completely running out of money.
Right.
So you're saying you need to be careful how you adjust the adjustments to your adjustments?
That's right. It's so, yeah.
Speaking of adjustments, so we've been talking stocks and bonds. When should people be looking at other products like annuities?
Yeah, it's always a consideration for retirees. I kind of look at it with, there's three basic ways you could fund a retirement spending goal over an unknown time horizon. You start with bonds. You could build a bond ladder. If you think I want to plan for 30 years, I build a 30-year bond ladder. And then generally there's two possible ways to spend more than that. One is the investment diversified portfolio. You don't just use bonds, but have a healthy allocation of stocks, rely on market growth to support a higher level of spending than you could with bonds. And that's mostly what we've been talking about thus far. The other approach is use longevity pooling through insurance, which can then support a higher level of spending than bonds, since those who end up not living as long will have less expensive retirements. But some of their annuity premiums then help to subsidize the payments to those who did live longer and therefore have more expensive retirements. Now that raises the standard of living of everyone in the risk pool, where you can consistently spend more throughout retirement than you could with bonds alone. And so now you have an option. What are you more comfortable with? Are you comfortable relying on the market and the risk premium through the market to support a higher level of spending? Or would you prefer the protections and safety of annuities and risk pooling to support a higher level of spending than bonds? And it's really at that point up to individuals and their preferences to decide on the direction they're most comfortable with, especially when it comes to funding basic expenses in retirement, not necessarily the overall retirement spending goal, but a floor of income that they really want to feel comfortable. It'll be there, it's reliable, and it's there on a lifetime basis. That's where a conversation around annuities to fill in any sort of gaps can be more meaningful.
Wait, this all feels very subjective. Is there any frameworks that exist that can help advisors figure out ways to allocate to annuities? I'm confused here. Do you have any thoughts at all?
Yeah. Well, that in that regard is a big question. Is now who prefers a different type of framework? And so Alex Mergie and I did a research study to develop this idea of the retirement income style awareness. And we found two primary factors that help to explain how people think about these things. This is all based on statistical work, but it was what I was just describing, what we call probability-based versus safety-first. If you're more probability-based, you're more comfortable relying on market growth to fund your retirement. If you're more safety-first, you're looking more for contractual protections to cover your core expenses in retirement. The other factor is optionality versus commitment. If you're optionality oriented, you really value flexibility above all else. If you're commitment oriented, you actually find satisfaction in, if I can figure out a solution that will solve my lifetime need, I'd like to get that taken care of and not worry about it, take it off my to-do list. And so the investment-based approach, the 4% rule, the conversation about it being 100% stocks, that's the world of total return. It's probability-based and optionality oriented. But if you're safety first and commitment oriented, we call that income protection. And that's much more the world of being comfortable committing to risk pooling and annuities and lifetime income protections to support basic expenses in retirement. And then that creates the comfort to invest more aggressively with the other assets because they're more for the discretionary types of goals in retirement.
There's a different way of thinking about this. And that is that if you follow, say, a 4% rule, a fixed withdrawal rate rule, and you have a traditional retirement portfolio that's maybe 60% bonds and 40% stocks, and you're going to invest your bonds in a bond mutual fund, the amount of income that you can draw from that bond, let's say you have $200,000, and you're going to withdraw $8,000 every year from that bond portfolio, but you're still going to have a certain amount of risk every year. Interest rates could go up and down. It's more efficient to take that bond portfolio and instead do an LDI kind of approach where you're essentially getting rid of all the downside risk of holding a bond portfolio to fund that same amount of expenses. And if you're going to do an LDI approach, the problem is that you don't know how long you're going to live. So maybe you do an LDI to the age of 100, because if you're a 65-year-old healthy woman, you've got a 10% chance of living to the age of 100, and you're willing to accept a 10% failure rate. Well, if you buy an annuity, then you're buying an LDI portfolio to the average longevity, and you're transferring the idiosyncratic longevity risk to an insurance company if you live longer than, say, the age of 90, which is the median longevity for a 65-year-old healthy woman. So in other words, from that $200,000, she might be able to spend, instead of $8,000, she might be able to spend $12,000 or $13,000 or $14,000. Now, when you think of the impact that has on your spending goal, you can cover more of your spending goal from that chunk of the bond portfolio, which means that you're pulling less money out of the remainder of your portfolio. And in fact, you can take greater risk with the remainder of your portfolio as well. So when you actually map out the outcomes with a partially annuitized portfolio, at every age, you're going to be spending more on average, and you're not going to be at risk that if you live a very long time, you're going to have to cut back significantly. And that's one of the reasons why we call the failure to annuitize the annuity puzzle, because you don't get any reward for accepting an idiosyncratic risk. And the only way to get rid of it is to transfer it to an insurance company. So why wouldn't everybody just do that? And I think one of the problems is because people don't really understand these trade-offs.
I mean, Michael used lots of big fancy words there. And to be fair, I would say most of my research, and probably our research, has really been focused on the economic benefits of allocating to products that provide more lifetime income. But I honestly believe it's more behavioral, the ways that it can, it's very difficult to spend down your portfolio when you have an uncertain lifespan, an uncertain future market returns. Right? I don't want to go back to work, and I'm afraid I don't know what to do. Right. So I honestly believe that we could exhaust your listeners with the economic arguments behind why individuals or households should have more money that's protected or guaranteed for life. I think it's really just creates that kind of foundation where, if you know that your essential expenditures, there's lots of fun words you can use there, are covered, it changes your relationship with your retirement savings, with how you're going to consume things like that. So, for advisors that are listening, especially, I wouldn't view the role of annuities as just that kind of economic piece. There's just that behavioral angle that you just can't overcome with a portfolio. I know that you, the advisor, help clients do that, but there's nothing that you can do that can assure them that they're going to have enough income to live off of to pay their essential expenditures for as long as they're alive.
I definitely agree with the math being behind this whole idea of taking bonds and replacing some bonds with lifetime income protections. It's going to support stronger financial outcomes in terms of spending and legacy. With this retirement income style awareness research, we found about 2/3 of the population ultimately resonates with an approach that builds protections into the financial plan as well. But we do still find 1/3 are comfortable with that total return investing approach. And I've been in so many battles about this over it's Dave Ramsey. He's total return. That's a clear example of this idea that there is 1/3 of the population that just doesn't resonate with the idea of annuities. And I talked about the primary factors, but there's secondary factors as well. If you are comfortable with a purely investment-based approach to retirement income, so you're probability-based, comfort relying on the markets, optionality-oriented, you want to maintain as much flexibility as possible. You also maintain an accumulation mindset, which is post-retirement, you're not worried about predictable income. You're still focused on risk-adjusted returns. And it implies you're going to accept a more variable spending stream because it's just not as important to you. You also tend to want to front load your expenses in retirement. You want to maximize lifestyle and make sure you can really enjoy your retirement. You also value technical liquidity, which is this idea of you just have a big pot of assets and you'll draw from it as necessary for different spending shocks, for your basic retirement expenses. You don't really try to do an asset liability matching this pot of assets is meant for this expense and so on. You draw from your pot of assets. And so when you have all those types of characteristics, that's the total return investor. And we think it's about a third of the population. And though I think the math, again, is not in favor of it as being a better way to support retirement, at the end of the day, that's what people are comfortable with. And I've stopped trying to argue that they should do something different.
So we've had conversations with Wade and David, both of you guys, about this and with other people. We talked to Moshe Milevsky about it. He's got a software that actually helps you model like the optimal annuity allocation and how it relates to the optimal stock bond allocation. And we took all that and we started talking to our clients about it, and nobody was interested. So either we're bad at selling annuities or there's a selection bias and we attract total return investors. I don't know what's going on there.
There's a lot of self-selection going on too, that if you're mainly discussing total return concepts, the people who reach out to you are more likely to self-select into being comfortable. You may be missing out. 2/3 of your listeners are potentially not calling you because, although I guess you are offering. It's just you got to build that audience more and get more of the income protection crowd into the audience mix as well.
To Wade's point, it's the language that we use to describe everything, right? I mean, in the US on statements, it's so balanced and return focused, and it's not. I mean, now we have new rules about relaying income, but like we've kind of created, especially wealthier Americans are like hyper focused on returns in the market, and it's not the goal and how do you accomplish the goal. It's how do you get solid performance, and like the structural story behind guaranteed income, lifetime income is a bit different, right? And so I think it might require different software, different tools, different ways to have conversations that make it, I don't know, more acceptable for retirees. And I see that like that is changing if you look at surveys on perceptions of annuities over time. But I don't know that a lot of advisors that are traditional investment managers are necessarily well equipped to tell that story. Michael, what do you think?
Yeah, I think there is a loss aversion and a framing problem as well. Is that people frame on the value of their savings, their nest egg. And if it gets smaller, then they have an emotional response to that. And you need to start thinking about the language that you use to describe how you plan for retirement. Because if you start focusing on income and lifestyle, and especially early in the planning process, then let's say if you create an expectation that you're going to buy $25,000 of income as part of the retirement plan, you even maybe separate an account where the purpose of the account is to buy that income. Then if you don't buy the income, it's going to seem like a loss. It's going to seem like you lost that $25,000 per year instead of you lost that dollar amount. So, it's one of the reasons why everybody loves their pension. Any guaranteed income that we get at retirement, we don't want to give it up. I mean, in the United States, we have this political battle over cutting Social Security. Social Security is an annuity, and people get bent out of shape when you try to take it away. And the reason is because that you've built this expectation that they're going to get this income. And when you reduce it, you're taking something away from them. So if you can set that expectation with a portion of their savings early on enough that they feel like they own that income and that taking the income away is like a loss, then I think you can do a much better job of helping people wrap their brains around what is ultimately going to be in their best interest.
Yeah, that's just that framing of it is a really interesting perspective, and not something that we've tried. How impactful is the idea of deferring government pensions like Social Security, or in Canada we have the Canada Pension Plan, same kind of idea? How impactful is deferring those to later ages?
Well, in the US, it's pretty impactful. And it's an actuarial calculation that was done in 1983, assuming a higher real interest rate and less longevity than we see today. So it meant to, in 1983, it didn't matter what age you claimed on an actuarial basis, but today you benefit from delay. And we're actually seeing a lot more. It used to be, we'd say half of people claim Social Security at age 62, which is the earliest possible age. But since 2009, that's been dropping dramatically. It's now under 30% are claiming at 62.
Wow.
And if you talk about waiting past the full retirement age, full retirement age is now somewhere between 66 and 67. But if you delay until 70, you continue to get these delay credits. In 2009, it was still under 6% of people waited past their full retirement age. But in 2021, it's now 24% are claiming past their full retirement age. So I think this is a point that us super nerds have been harping on for a long time as well, about the value of delaying Social Security. And it really does seem like that message has been getting out there in a dramatic fashion these past 14, 13 years.
So I have some research with Jason Bichner that we published soon in the Retirement Management Journal, using data from the Survey of Consumer Finances. And what I was really curious about is there any kind of relationship between when individuals claim Social Security and whether or not they use a financial advisor? I think if you were to ask me that question, I mean, you have to control for effects where individuals that have an advisor tend to have more wealth. But if you were to ask me, David, like, how does the relationship to claim Social Security relate to having an advisor? I would say, well, advisors are highly knowledgeable of this effect. People that have advisors claim later than those that don't, right? That's like the obvious answer. Well, that is not what you actually see. There's a marked difference based upon when individuals claim and the type of the advisor that they're using, whereby individuals work with brokers claim 2 years earlier than those who work with accountants. Right.
No
and so
way.
that, like,
Why?
if you think about it, like there's lots of ways that you can nudge someone to claim earlier or later. Like if I wanted to scare you to claim it, like, like, oh my God, the trust fund is going bankrupt. Like, what are we going to do? Like, how are we going to fix this? We can't rely on Social Security. Alternatively, you can say, hey, even if it runs out of money, they're still 80% funded. The odds of a cut to benefits is incredibly small. And the fact that there's this marked difference in claiming ages by advisors, to me, at least implicitly suggests that advisors can help drive that narrative to the extent they want to. And, I don't want to get in this kind of fight about who's a better advisor, but think about it, like the way that a broker versus an accountant makes money. They're very different business models, right? And that could, I think, be directly affecting the way that people receive advice around the benefits of delay claiming Social Security. And let's be honest here, like retirement academics don't always get along, but that's one of the few things that we almost all say makes a lot of sense. And I was very disheartened to see that, advisors, I would have thought, like they're having their clients are delaying, years longer than average. Individuals that use brokers actually claim average before the average American does. Like that does not jive with what I think anyone would expect.
No.
There's a strand of investment advisors who think they can, quote unquote, invest the benefits better. So it's better to claim early and invest it. And they think that will help you be better off in the long term. That is definitely more of a total return style compared to if your income protection, you view delaying Social Security as the best annuity money can buy. And so it's a natural inflation adjusted part of the retirement income floor that you want to build into your retirement plan.
Well, to loop back to our earlier comment, if you think you can earn 12% a year without risk, you're not going to delay claiming Social Security, right?
Yeah,
so
if you could earn 12% a year, you claim at 62.
You're going to claim at 62. And so like there are really important implications, right, about, he's just talking about withdrawal rates. Well, like individuals that utilize that advice and those perspectives are going to make poor choices in other domains potentially as well.
Mm-hmm.
Yeah, just a quick point also about any sort of a government pension that is inflation adjusted. It's really the only way to buy more inflation protected lifetime income. So if you want to buy an annuity that doesn't lose purchasing power over time, the only way in the marketplace to get it is by delayed claiming of your government pension that's going to then adjust for inflation over time. To me, I have some things that are just kind of no-brainers as part of the retirement income planning process. And to me, delayed claiming of a government pension is a no-brainer because A, it's annuitized income, which you should get anyway. B, it's inflation protected, which you can't get anywhere else. And C, the ability of the entity to always make that income payment is pretty good if they print the money. So, it's not like an insurance company where there is some chance of insolvency risk. With the government, generally speaking, if they can print the money, then you're going to get the check.
Although it is harder to print money to pay for inflation-linked claims because that can cause more inflation, increasing the amount you have to pay into a negative feedback loop.
But that just makes everything else that's not linked to inflation worth less. And so people go, oh, I mean, so it's like that's true, but that means everything else that's not linked to inflation will be hurt even more, right?
Mm-hmm.
So.
Can you guys have a paper looking specifically at delaying Social Security for higher earning women? Can you talk about why it's more important in that case, or why it's important in that case?
Yeah, so when you get a delayed claiming credit, it's gender neutral. So in other words, everybody gets the same bump up in income. Where if you did this in the private sector, you would give women a less of a bump than you would for men. Why? Because women are going to live longer. So in other words, the way you price an annuity is you take the probability that they're going to be alive to cash the check multiplied by the present value of that payment. And since women are expected to live longer, by delayed claiming, they're on average going to have a higher probability of being alive to cash the check. Present value is going to be the same, all else equal. The actuarial value is going to be higher for women than it is for men. So it's something to consider that, because of this gender blind pricing that goes on with delayed claiming, women actually get a bigger advantage to delayed claiming than men do. And also, you have to pay attention to some of the claiming rules, because if you, for example, have an older, higher earner and the younger spouse can get the income benefit of the older, higher earning spouse, then they should delay claiming, because essentially the value of the annuity is based on the younger spouse whose expected lifetime is significantly longer. So when you delay claiming and they have the eligibility to receive that benefit when the higher earner passes away, that increases the value of that annuity.
Really cool.
So my final question for each of you, what final message would you have about retirement income that you might want to leave our listeners with?
I can go first. It kind of came up in the conversation. There's a lot of different ways to get it right. You really need a retirement plan that you're most comfortable with. So if you're not comfortable with an 8% withdrawal rate in 100% stocks, or you're not comfortable thinking about an annuity because you just don't want to make that irreversible decision, it can be hard to sort through those options. And so that's really was the motivation of really trying to identify there's these different retirement income styles. And I think people are interested to determine their style. There's definitely possible ways to do that now. And it's important to understand what your style is so that you can quickly cut through all these debates and find the approach that actually resonates with you.
I mean, I would say that there's a really important value to just a second opinion when it comes to retirement income. If you're a do-it-yourselfer, engage an advisor. It could be like an hourly plan. If you have an advisor, I still see value in getting a second opinion. So I think that whether you're your own advisor or you work with one, just getting a gut check as you really enter retirement, make a lot of choices, that can be incredibly valuable, right? It's not that your advisor isn't competent or that you as an individual aren't competent yourself, but having someone else that can just say, hey, this makes a lot of sense is really important, because you're going to make a lot of choices when you first retire that have massive long-term implications. You're going to set your spending. You might claim Social Security. You might you might buy a product. You want to have a high level of certainty that what you're doing is correct. And I think that's where having someone else to give you, ideally, a second set of eyes is just really important.
David, there was just an article in Barron's today about someone who hired a professional advisor and had $50 million and now has $1.5 million. So I think also when you're hiring an advisor, it's very important to find someone who you trust, who is going to be looking out for your best interest, especially once you get older, because you do change cognitively when you're in your 80s and 90s. And I think part of the retirement planning process is accounting for the fact that your ability to manage complex financial decisions is going to be different in your 90s than it was in your 60s. So figure out a way to protect your ability to consistently make high quality decisions. And the other thing I'd say is just to be more deliberate and to recognize that there really are only two places that your money can go. You can either give your money to someone else, when you die, or you can spend it. And I think that one of the biggest mistakes I see among retirees is they believe that there's a third option that doesn't exist. So they preserve their assets as long as they possibly can. And if you ask them, do you want to give that money to your kids? They'll say, no, that's not why we're hanging on to all this money. And essentially what ends up happening is by default, the kids end up spending it because they didn't feel like they had the license to do that. And I think that's one of the parts of being deliberate, is giving yourself the license to be able to spend the money you saved for the purpose of living better.
And it didn't come up organically, but I was proudly wearing my Rational Reminder t-shirt for
Nice.
today's episode. So,
Very
Love
nice.
it. It's very nice.
I want to ask you too, Wade.
He just went full Superman on us. He just pulled the
Yeah, Superman.
so just the cape.
Rational Reminder.
That's Wade.
It's pretty good for a super nerd. I mean, that's what a super nerd would have on the shirt.
Rip off the jacket.
Wade, you mentioned earlier a RISA risk profiling tool, and you mentioned that there may be tools available for people to use. Where do people find that?
Yeah, I'll get a link put together for you to include in the show notes if you like. We'll put it at risaprofile.com/rational reminder. And it'll be an opportunity to take the questionnaire assessment and get a report that shows your retirement income style.
That is super cool.
That is.
Awesome. All right. Thanks a lot, guys. We really appreciate you all coming on. I think it's a great conversation.
Really, thank you.
Yeah, it was fun.
Yeah, this was fantastic. I'm very grateful to have you guys join us. Thanks so much.